Dear students, let us understand the fixed and fluctuating capital by looking at this example. Show how the following items will appear in the capital accounts of the partners Anbu and Balu when their capitals are fixed and fluctuating. So we have to prepare capital accounts under both the methods in fixed and fluctuating. And what are the information available? The first is capital and the second is drawing, interest on drawings, interest on capital, then partner's salary, commission, then share of profit. Students, please don't mind about the year. These are all the standard problems lifted from study materials, so don't mind about the year. Yeah, so we have to prepare capital accounts and recollect. For partnership capital accounts there are two methods. One is fixed capital method and the other one is fluctuating capital method. So in fixed capital method we have to prepare two accounts, namely capital account which will remain fixed and current account where all adjustments will be made, whereas in fluctuating capital method only one account will be prepared, that is capital account, and all adjustments will be parked in that. So let's go back to question. See, this capital is the opening balance, fine. Drawings will reduce the capital, so if capital is liability and if it is on the credit side, drawing should be debited because it's going to reduce the capital. And interest on drawings will reduce along with drawing, so this should also be debited. Interest on capital will increase the capital, so it should be credited. Partner salary will increase the capital, it should be credited. Commission is going to increase the capital, it should be credited. And share of profit is going to increase the capital, it should be credited. Provided we are following a fluctuating capital method, because in fluctuating capital method all these items will increase the capital and these two items will decrease the capital, so it will be debited. So students, understand, in fluctuating capital method all these items will have a bearing on the capital which will either increase the capital or decrease the capital, whereas in fixed, let whatever be these transaction, the capital will remain fixed at 90,000 and 70,000 because capital will be kept in a separate account. So first we'll understand what is fluctuating capital method. To the question says have it as B, item B, will do the fluctuating capital first, then we'll do the fixed capital. So we have the format here. There are two partners, basically Anbu and Balu. So we have the format. So first what we are going to do is fluctuating capital method. So in fluctuating capital method we are going to have all adjustments within one account itself. So what account it is? It is capital account. It is capital account of Mr. Anbu and Mr. Balu. So what is the capital introduced by Anbu and Balu, or what is the opening balance of capital? Yeah, come back here. Capital on 1/4/2004 is 90,000 and 70,000. So we can write by balance brought down. Why I am writing on the credit side? Because capital is a liability, by default it will have a credit balance. So we will write 90,000 introduced, or it's the opening balance of Anbu, and 70,000 is the opening balance of Balu. Then we'll go back to question. The second item is drawings and interest on drawings. These two, as discussed, these two will reduce the capital. In fluctuating capital method we will do everything in capital account only. So we will take these two items to the debit side of the capital account. In fluctuating capital all adjustments will be made within the capital account, right? So we'll write here two drawings. Both the partners have drawn. What is the drawings amount? If you recollect, the drawings is 360 and 270. I'm sorry, drawings is 12,000 and 9,000. So we'll write 12,000 for Anbu and 9,000 for Balu. And when they draw, it reduces their capital, and that interest on drawings will also reduce the capital because that is also part of drawings. So we'll write 2 interest on drawings. And what is the amount? Interest on drawings is what we have. It is 360 and 270. And when we are giving effect for these entries, this is for the year end. This is drawings during 2004-05. So we should give the appropriate date, and if we are not going to have the appropriate date, then we'll have it as year end, that is 31st March 2005. We are talking about 2004 position. So we will write here 31st March 2005. So that part is done. We'll go back to question. So the third item is interest on capital. Interest on capital is going to added with the interest, added with the capital, and partner salary and commission are all credit to them. It's going to increase their capital level. So all the three items should find a place on the credit of the partner's capital account. And what about the share of profit? This is also something which is going to improve the capital of the partner. So all the four items should find place on the credit side of the partner's capital account. But here thing is, Mr. Balu does not have salary and Mr. Anbu does not have commission. So we have to just keep that in mind. So let us write by interest on capital. It's 5,400 and 4,200. The next item is salary, by salary, and only Anbu is entitled to salary 12,000. Balu does not have any salary, and by commission, and that is only for Mr. Balu. Anbu does not have any share in commission, so it is 6,000 only for Balu and not for Anbu. And share of profit will write by P&L account, because the share of profit is taken from profit and loss account. That's why partner's capital account is created by P&L account, and we have seen in the question it is 6,000 and 4,000. So I think now we have attended to all the items given in the question. Now let's total the credit side first, because we have more items there. So it is 1,13,400 and 84,200. Look at the debit side, it is comparatively lower. So there's going to be a balance, and 1,13,400 minus these two items will give us a balance of say 1,01,040, and 84,200 minus these two items 9,270 will give 74,930. So this is the balance. In capital account as on 31st March 2005. What is the balance brought down? It is 90,000 and 70,000. When it was brought down, intentionally I have not written the date, because to make that comparison now, it was brought down on 1st April 2004. On 1st April 2004, the capital of Anbu was 90,000, whereas in the year end, that is 31st March 2005, it is 1,01,040. Similarly for Balu, it was 70,000, now it has touched 74,930. So the capital has become fluctuating because of adjustments of these items on the debit and credit. So this is the effect of fluctuating capital method, where the capital will not remain intact, it will keep on changing due to various adjustments. So we have now understood how to prepare the capital account under fluctuating capital method. Now let us also try to prepare the capital account under fixed capital method. In fixed capital method, how many accounts will be prepared? In fixed capital method, 2 accounts have to be prepared. The first will be the capital account, and the next will be the current account. That's very important. The first is going to be the capital account, and next will be current account. So what will find a place in capital account? Only the capital introduced. See, on 1st April 2004, the balance brought down, whatever the capital introduced by Anbu and Balu, it is 90,000 and 70,000. So we'll write 90,000 introduced, or it's the opening balance, and Balu had 70,000. What will happen with capital account is no other adjustments will be entertained. So in the year end, this account will be closed. This account will be closed on 31/3/2005, and it will be closed saying to balance carry down 90,000 and 70,000. So the account is going to be closed here now. So we'll have 90,000, 70,000, and on the credit also it's going to be 90,000, 70,000. So next year on 1/4/2005, if it is seen, it will be like by balance brought down, it's going to be the same 90,000 and 70,000. So what could be understood from this is, year after year after year, the capital will remain fixed under fixed capital method. That's why it's called fixed capital method. So unless as additional capital is introduced, this capital account will not undergo a change. So what will happen with current account? See, you look at the fluctuating capital method. Only this is the capital portion and all other items are adjustments, right? All other items are adjustments. So all these adjustments will find a place in current account. So what we'll do, we'll take all the adjustments except this capital to the current account. Our first adjustment is interest on capital, which is 5,400 and 4,200. Our second adjustment is partner salary, where only Anbu was entitled to 12,000 and nothing for Balu. The third adjustment is commission, where Anbu does not have any commission, Balu has a commission of 6,000. The fourth adjustment is share in profit, where Anbu had 6,000 and Balu had 4,000. So all the items which is going to improve the partner's position is shown on the credit side, and two items which is going to reduce the partner's position is drawings and interest on drawings, that's going to be on the debit side. So drawings by Anbu is 12,000 and by Mr. Balu is 9,000. Interest on drawings for Anbu is 360 and interest on drawings for Mr. Balu is 270. So we have total of 23,400 on the credit of Mr. Anbu and 14,200 on credit for Mr. Balu, and here there are only two items, so there is going to be a balancing figure that's going to be 11,040 and 4,930. So this is the balancing figure. So we'll write two balance carry down, it's going to be 3135. So whatever the changes is required, that is, or adjustment is required, that is given effect in the partner's current account, and the capital account is kept intact in the fixed capital method. Thank you.